You know, when you grab something off a shelf at a store, have you ever really thought about its journey? There's this whole hidden story behind every single item, and it all revolves around one word: inventory. So today, we're going to pull back the curtain and see how companies manage all their stuff and, get this, how a simple choice in how they count can save them millions. All right, let's just start with the big puzzle right away. How on earth can a simple accounting choice, literally just how you count boxes in a warehouse, end up saving a company millions and millions of dollars in taxes? It sounds kind of crazy, right? But it's a very real strategy that some of the biggest companies use. And we're going to break down exactly how it works. But first things first, before we get into all the clever tax-saving stuff, we've got to be on the same page about what business inventory actually is. Because trust me, it's a whole lot more than just the products you see sitting on a shelf. So for a regular retail store, it's pretty simple. Inventory is just the merchandise they buy to resell to you. But for a company that actually makes stuff, it's a three-stage journey. It all starts as raw materials. Think like lumber and nails for a furniture company. Then it becomes work in process, while all those bits and pieces are being put together. And finally, voila, it becomes a finished good, like a chair that's all ready to be sold. Okay, so you can imagine, with all these raw materials and half-finished products and completed goods floating around, how do companies keep track of it all? Well, they need a system, right? A way to know what they have, what they've sold, and what it all cost. And there are basically two main ways they do this. On one hand, you've got the perpetual system. You can think of this one like a super attentive watchdog that's always on duty, updating the records in real time with every single sale and every new shipment that comes in. Then you have the periodic system. This is more like a big year-end census. The company doesn't track every little thing. Instead, they do a massive physical count at the end of the period to figure out what's left and what was sold. Okay, now we're getting to the heart of it all. This is where it gets really interesting. Picture a hardware store. Let's say they buy a barrel of nails for $10 in January. Then in February, prices go up, and they have to buy an identical barrel for $12. Now, when a customer comes in and buys one barrel, which cost should the store use for its books? The $10 one or the $12 one? This is a huge decision. And this is where something called a cost flow assumption comes into play. It's basically the rule a company decides to follow for assigning these costs. And here's the wild part. It's just an assumption. It doesn't actually have to match which physical barrel walked out the door. The company could sell the barrel they just bought in February, but for accounting purposes, pretend it was the one from January. It's a strategic choice. So companies have three main flavors to choose from. The first is FIFO. That's first in, first out. It assumes the oldest stuff is sold first. Just like a grocery store pushes the older milk cartons to the front. Then you've got LIFO, last in, first out. It's the exact opposite. It assumes the newest stuff gets sold first, kind of like taking sand off the top of a pile. And finally, there's the average cost method, which, you guessed it, just mushes all the costs together to get a nice, smooth average. Now, this choice becomes incredibly important when prices are going up. If you use FIFO, you're matching your old, cheap inventory costs against today's high selling prices, and that makes your profit look bigger on paper. But if you use LIFO, you match your newest, most expensive costs against those same sales. That makes your pre-tax income look smaller, and a smaller income means, a smaller tax bill. So this isn't just some boring accounting theory, right? This stuff has a huge, tangible impact on a company's bottom line. Let's stop talking theory and look at a real-world example to see how this actually plays out. Check this out. This is real data from Rite Aid. In 2011, you can see they reported their inventory using the LIFO method, and it was valued at about $3.1 billion. But look at this line here, FIFO conversion. That's the key. That's how much more their inventory would have been worth if they had used FIFO instead. And in 2011, that difference was a whopping $875 million. So what does an $875 million difference actually mean in real money? It means that by using LIFO, Rite Aid was able to report higher costs over the years, which lowered their taxable income by that much. If we just assume a 30% tax rate, that simple accounting choice saved them an estimated $262.5 million in taxes. And there you have it. That's the answer to our puzzle. But there's one more piece to this whole inventory story. What happens when stuff just goes bad, or gets damaged, or goes out of style? I mean, think about fruit that spoils, or last year's smartphone model that nobody wants anymore. A company can't just keep pretending that stuff is worth what they originally paid for it. When the value of inventory drops below what it originally cost, companies have to do something called an inventory write-down. It's basically an accounting entry where they just admit, hey, this stuff isn't worth as much anymore. It lowers the inventory's value on their books and recognizes it as a loss. It's really all about being honest and making sure the financial reports reflect reality. So, how do they do it? Well, the rule is pretty simple. Companies have to value their inventory at either what they paid for it or what it's worth on the market today, whichever one is lower. The exact way they calculate this depends a little bit on whether they're using LIFO or FIFO, but the end result is the same. Both their reported inventory and their net income get reduced. So, the next time you look at a company's financial report, don't just see a number next to the word inventory. See the whole story behind it. See the strategic choices they made between FIFO and LIFO. See the real-world impact that choice had on their taxes. And see the honest accounting for all the products that just lost their shine. It's not just stuff on a shelf. It's a whole series of crucial decisions that define a business.